Good afternoon, everyone. My name is Thomas Gorman, and I'm the Client Success Coordinator here at the Klein Fund. Um, Today, we are going to address one of the biggest questions that we get here, and that is how do we create financial projections for a startup or for an existing business? Um, Seems to be a very intimidating topic for a lot of our clients. So I hope with this tutorial, I can clear up a little bit of the confusion around this topic, add some clarity, some sense of direction so that everyone can get their projections completed. So without further ado, let's hop in. First, we need to say a few things about financial projections to just kind of define what it is we're working on. Financial projections are a research exercise, and the numbers that you come up with are only as good as the research that you put into them. And projections should take the form of a profit and loss statement and a balance sheet. Please do not type these projections up in a Word document in paragraph form. We're not writing a story here. This is all about the numbers. So we want to see those numbers laid out in profit and loss form and in balance sheet form. We need a monthly profit and loss breakdown for the first year, and we need annual profit and loss breakdowns for year 2 and 3. So to put a visual to that idea, this would be what year 1 is going to look like. As you can see, it's broken down by month for your sales, your cost of goods sold, and your operating expenses. And then for year 2, you can see that it's not broken down by month. We just have annual numbers instead of monthly numbers. And that is just like in year 1, that's the same for sales, cost of goods sold, and operating expenses. Um, and then we want to look at your balance sheet, which would look like this with your assets listed up at the top. Down at the bottom, we have liabilities, long-term and current, and the equity that you have in those assets. And startup balance sheets are fairly simple. Generally, startups don't have a lot of assets. These are not going to be complicated balance sheets, very simple. Um, so don't let these intimidate you. They're really not that complicated. And the next thing that needs to be said is that keep in mind that um, you're asking to borrow capital to invest in your business. So as lenders, we need to see how all of this is going to transpire financially. We need to see how this will create additional revenue for your business or how this will generate revenue as a startup, to see how you will be able to pay this loan back. And these projections are how you're going to demonstrate that to us. Um, and if you feel like you simply don't have the financial skills to be able to do this on your own, there are folks over at the SBDC, over at SCORE, or I Hope Women's Business Center, or any of the women's business centers. They have professionals on hand that can help you with this at no cost to you. So if you're feeling like you need someone to sit down and help you with this, please reach out to these folks. That's what they're there for. So don't hesitate, reach out to them, tell them you need assistance, and they can help you with this. And with that said, let's start by looking at what a startup needs to do to create financial projections. Now, for startup businesses, you're starting with a clean slate. You don't have any historical records of what sales are going to look like. You don't know what the cost of goods sold is going to look like. You don't even know what types of operating expenses you're going to need. Um, and so for for me, the way I look at things, a startup in this situation, the best place to start with your projections are the operating expenses. Now, you'll need to figure out what type of expenses will be required to conduct daily operations in your chosen field. And this can be accomplished by interviewing local business owners. Maybe you have a mentor in the field that you're wanting to get into. You can have discussions with accountants that work with people in this field, business consultants, or you can just do some market research through industry associations or industry publications. But the first step is to figure out what type of operating expenses you're going to deal with on a monthly basis for your business. Now, this right here is a list of operating expenses: auto expenses, bank charges, insurance expenses, legal and professional expenses, licenses and permits, merchant fees, office expenses, payroll tax expenses. This is all a list of operating expenses that are fairly common with businesses. Now, from business to business across industries, these operating expenses will look different for each individual business. So first, we need to figure out what operating expenses we're going to have. Um, and like I said, you can sit down with small business owners, with accountants, with business consultants, with mentors, just wherever you have to go to get this information. What kind of expenses are we looking at on a monthly basis? Once you get that information, at that point, you need to start calling around and getting quotes and estimates for these operating expenses. Now, I have created some numbers here to get our annual operating expenses figured out. So let's start by go ahead and entering in these expenses. So auto expense, we've got 150. Bank charges, $20 a month. Insurance, $1,500 a month. Legal and professional, $300 a month. Licenses and permits, we are only going to usually pay for a business permit once a year. So we'll just say that business permit is $700 a month. Our merchant fees, we're looking at about $400 a month. Office expense, $200 a month. Payroll taxes, we're going to say $1,500 a month. Health insurance, $800 a month. And just so you know, we're going to say this is going to be a business with two employees. Maybe it's a husband and a wife. Maybe it's two business partners. Anyway, that's what we're looking at. So next up, we've got postage and delivery. We'll say we'll spend $50 a month. Repairs and maintenance. What do we have for repairs and maintenance? We've got $150 a month. Rent and lease, we're looking at $1,800 a month. Salary expense, we're looking at $4,000 a month. Security expense, we're going to say $75 a month. Supplies expense, $300 a month. Uniform expense, $75 a month. Utilities expense, $300 a month. We have a wage expense on here. Right now, we're going to say our wages are $0 because we have two employees and the total salary for them is going to be $4,000 a month. And your wage. If you hire another employee at some point in the future, you'll have this slot here to add those expenses in. Now, so we are going to assume that um, these operating expenses are going to be fairly stable throughout the year, just for the ease of this exercise. So for each of these, we're going to project all the way. Oh, we gotta backtrack on that. We want to make sure that we don't go all the way out. We want to stop in month December. Okay. Here, go all the way to December. Legal, professional, all the way to December. Licenses and permits. Again, I said we're only going to pay that once per year. So for the rest of these, we are just going to enter in zeros. Merchant fees, again, pretty much all of our other expenses. We're just, as I said, for the ease of this exercise, we're just going to assume that they stay constant throughout the year. Obviously, your rent is something that's going to be constant. Usually your payroll is going to be fairly constant. But for the sake of this exercise, we're just going to make everything constant throughout the year. So just sit tight with me while I get these numbers into our sheet. And another one of the reasons why I like to do the operating expenses first is because it lets you know where your break even point is going to be. The break even point is the point at which you begin to make a profit. So let's just say if your business has, well, let's finish this off first, and then I can explain it with a little bit more clarity. So the month of January here, we see we have $12,320 in operating expenses, and that counts our $700 business license that we paid in the month of January. For every other month, we see that we operate with $11,620 worth of operating expenses. So for the month of January, our break even point is going to be $12,320. We have to make that much in revenue uh, just to break even for the month, or we have to make that much in gross profit just to break even for the month. Um, for every other month, that number is 11,620. So we have to get our gross profit for the month of January to equal $12,320 to break even. For every other month of the year, our gross profit has to equal $11,620 to break even. And so that sets us up to now look at our uh, sales and our cost of goods sold. So we're going to operate under the assumption that we are in the retail business and we are primarily going to be selling um, two products. So we've got 5 different sales categories. We're going to use product 1 and category 1, product 2 and category 2. Okay, so now let's just say we sold $20,000 of product 1 January. And let's say we sold $15,000 in product 1 for January. Now, The next thing we need to do is figure out what our cost of goods sold is. So we're just going to pick a nice easy number. So we'll say that we mark our products up 100%. So for our cost of goods sold for this month, we're going to say equals $20,000 times 0.5. So then we have $10,000 of cost of goods sold. For product two, we're going to do the same assumption. Equals 15,000 multiplied by 0.5. So we bought $7,500 worth of product two. We sell that for 100% markup, which gives us $15,000 of revenue for product two. We purchased $10,000 worth of product one. We mark that up 100%. We make $20,000 out of product one. So then the next thing I want to show you guys how to do, and many of you may already know this, but these are just small skills that come in handy in Excel. If we want the spreadsheet to add up the numbers in the column of sales, category 1 and 2 for January, we would type equal sum, open parenthesis, highlight these, close parenthesis, and there you see 35, 20 plus 15, 35,000. We'll do the same. We did the same thing. Let's see, equal sum. There we go. And so for the month of January, we have $35,000 in revenue. The cost of the products that we sold was $17,500. So then we see that leaves us with a gross profit of $17,500. Now our total operating expenses for the month of January was $12,320. We minus those from $17,500. And that gives us a monthly profit the month of January of $5,180. And that would be your net income. Okay, so obviously throughout the year your revenues are going to vary, and really it just depends upon what industry. In some industries your summer months are going to be busier, in some months your winters are going to be busier. It really just depends on what type of industry you're in. So let's just give ourselves some numbers that vary here. So we'll say we did 18,000 in February. We did 22,000 in March. Let's just say we did 15,000 in April. Let's say we did 15,500 in May. We did 19,000 June, 18,000. Okay, we got 16,000. Let's just say we got numbers went down in September. 23,000. 18,000. 20,000. All right, and we'll do, and these, I just came up with these numbers off the top of my head. Obviously, you guys are going to want to put a little bit more thought into it. You know what kind of business you're in. You know what months of the year that business tends to be more engaged with its clientele. So you guys are going to put more thought into your sales numbers than I am, but I'm doing this just for the purposes of showing you guys how to do the projections. Then this one we'll put 16,000 a month, say 10 Say we did 12 here, 16 here, 11 here, 19 here, 18, 9,000, 11,000, 12,000, 14,000. Okay. And then we're going to take our cost of goods sold. And if we just drag that little square right at the bottom, it'll take our formula, which is right here, and it'll apply it across all of these. So click on our little square. We drag it across into the month of December. There we go. Same thing for cost of goods sold for product 2. We take our little square right there, and it'll drag our formula that we created all the way across. There we go. Remember, we said we mark our products up 100%. So the sales numbers should be double the cost of good numbers. So check our work. We got 18,000 here. We got 9,000 here. We got 16,000 here. We got 8,000 here. 22, 11, 10, 5. Go all the way down to December. 20,000 here. 10,000 here. 7,000 here. 14,000 here. Okay, there we go. And so do the same thing with our total here. Take that, drag it across, and then we have totals for each month of the year. Now, over here, again, equals sum, and this is going to give us our total sales for product 1 for the entire year. Equals sum, and we're going to highlight everything in product 1 from January to December. Close parentheses and enter. We can see we sold $215,500 of product 1. Same thing here, equals sum. Product 2 from January all the way to December. 163,000 of product 2. Here we go. We want our sum. And then I think we can just drag this across and it should give us our total. Yep, there we go. I do the same thing here with our cost of goods sold. Same thing here. Equals sum. And then we want all of product 2 for January through December. Okay. So now do that for total cost of goods sold as well. All right, there we go. So we have year 1 of our profit and loss completed. So a couple things you'll notice here. Our total sales were $378,500. We said that we mark our products up 100%. So that means that our gross profit should be equal to the same thing as our cost of goods sold. So our cost of goods sold would be equal to our gross profit if we're going under the assumption that we're marking everything up 100%. So 189,250 times 2 is equal to 378,500. So all of that is correct. We just checked our work. Now, you can see with these numbers, we have profited every month. Remember, we said that our break-even points were going to be what our total operating expenses are going to be. For the month of January, they were 12,320. For every other month of the year, they were 11,620. We can see that our gross profit um, for every month other than the month of September, we exceeded our break-even point. So the month of September was the only month that we did not make a profit in. We lost $1,620 on that month. But for the year, we made $49,110. So that's what the year one is going to look like. Now, with the conclusion of the profit and loss for year one of a startup, that's pretty much the end of the differences between doing projections for a startup and doing projections for an established business. Remember, we said that projections for an established business begins with historical data from financial statements of months and years past for an existing business. Well, now we have at least 1 year of projected data for our startup. So now moving forward in this, we use this data and we change it through multiplying these numbers by percentages. Now, those numbers are going to be a representation of our expectations for how business how we expect business to transpire in the following year. So, if this is a startup and we want to say that next year the revenue will increase by 10%, then we need to show the sales data from category one, product one, represented by an increase of 10% on year two. So how do we do that? Well, let's do it. So we're going to go to year two right here, sales category one. And so we're going to begin by going equals. Then we're going to go back to year one. We're going to use this data. Remember, we said product one, year one, sales category one. So we're going to click that. And then we're going to do times 1.1. And we're using 1.1 because we said sales are going to increase by 10%. So 1 would give us the 215,500, and the 0.1 would represent that 10%. So then we hit enter. And there we have our 10% increase on product number one for year two. And we would do the same thing for sales category two. So again, we go back. Well, we don't go back. We do equals. And we go back to year one projections. Select product two times 1.1, enter. And there we have the data for product two, year two. So you can already see this is going to be much more a much easier time with projections for years 2 and 3 than it was for year 1, because in year 1 we had to come up with just raw numbers through research and educated guesses. And now we're simply building upon those numbers with our projections for year 2. And it's going to be the same thing for an existing business. You would just pull your data from last year, figure out how you anticipate things to change moving forward, whether that's, increased sales capacity, increase manufacturing capacity, whatever the assets that you are going to be purchasing with the funds that you're borrowing. You want to put those increased capacities into your projections for years 1, 2, and 3. So it's the same process either way now for a startup or an existing business. So moving forward, we can go on to cost of goods sold. Once again, it's going to be the same thing we did for products number 1 and product number 2. So we go equals, go over to our year number 1, select our cost of goods sold for product 1, multiply that times 1.1. Here we go. Again, same thing for product 2. Equals, go back to year 1, product 2, times 1.1. Enter, and there we go. And it's really that simple. So now we would move forward into our operating expenses. Generally, a good rule of thumb is to peg the increase of your operating expenses to the inflation rate. So you would see generally inflation is around 2 to 3%. Federal Reserve's target inflation rate is 2%. Obviously the last couple of years it's been a little bit higher than that because of conditions that we're experiencing as a result of the pandemic, of supply chain issues, etc. But a good rule of thumb is 2 to 3% on your increase on your operating expenses. So right here, auto expense equals. We go down to auto expenses for the year. Select times 1, and we said 2 to 3%. Let's be conservative and we'll go to 3% on this one. So 0.03. Here we go. Equals. Select our insurance expense times 1.03. Enter. There we go. Last but not least, we've got utilities equals times 1.03. There we have it. So that is year 2. And that would be the same for either a startup or an existing business. And then we're just going to repeat the same process for year 3. Let's use a different number for year 3. Let's say, our sales dip a little bit in year 3. So instead of 10% increase, let's say we've got a 5% increase. So we would go equals year 2 sales, category 1, product 1 times 1.05. Same thing for product 2 times 1.05. Cost of goods sold equals times 1.05 times 1.05. All right. And now we will do the same thing for our expenses. Times, we set our inflation to 3%. We'll stay constant with that for year 3. So times 1.03%. And then we'll do that for each of our operating expenses. And there we have it. And that's basically, what is required to get the profit and loss projections for years 1, 2, and 3. So you've seen, how we would handle this if we were a startup, now how we would handle this if we were an existing business. Um, so we can move forward to the balance sheet, and that will complete this tutorial. As I said earlier, the balance sheets for startups are very simple. There's usually not much assets involved. Um, so for the sake of this argument, let's just say you came to Climb Fund to borrow $100,000. Um, so for the sake of this argument, let's just say $100,000. And with that $100,000, you were going to buy equipment, you were going to rent a building, you were going to buy inventory, you were going to buy all the things necessary to start your business. Um, Now, on top of that, let's say you brought in with you $20,000 of your own money. So then we have a total of $120,000. Um, that let's, we can divide that up amongst your assets. So say you put 20,000 of that in the bank for operating expenses, and we spent the other 100,000 on equipment, on inventory, on all of the other things. Now you can break that down by categories. If you wanted to break it into inventory, we could put inventory right here, and we could label that at 5,000, reduce that to 95,000. So you can kind of see there that, how we've got that broken down. These are your assets. So you've got property and equipment, you've got inventory, you've got cash, um, and that's pretty much all that's going to be required there. On the asset side, we can go down to liabilities. Um, your long-term liabilities, remember we said we borrowed 100,000. So that 100,000 is going to go right here. And we brought in 20,000 of our own money. And so we can see our balance sheet now balances out. We have a long-term liability of $100,000. That's the money you would have borrowed from Climb Fund. You brought in $20,000 of your own money. So we'll label this as owner's equity. And so your assets, we have $120,000 of assets. Your liabilities and equity, we have $120,000 of liability. And that basically meets the biggest rule that we have for a balance sheet, is in that rule being it has to balance on both sides. Assets equal 120, liabilities and equity equals 120. And it's really that simple. I haven't seen many startup balance sheets that are more complicated than this. Now, as your company grows and your assets grow, your balance sheet will get more complicated, but that's a good thing. It lets you know your business is growing, it's got more assets, it's worth more money. But for starting up, this is basically what you're going to be looking at. So this is a tutorial for how to do your projections. This should clear up the majority of the questions that you have. Now, certainly there can be little questions, detail-oriented questions that may confuse you. I'm always here to answer those questions. If you guys want to reach out to me, my email is thomas at climbfund.org. And, if you guys got any questions, always feel free to reach out to me. I'm here to answer any questions that you have. And for you guys that would like to use this template, it is available on our website. If you go to climbfund.org, scroll over to the Our Lending tab, look under that tab and you'll see our Business Resource Center. Scroll down the page and it's towards the bottom. All right, guys. Thank you so much.